Imagine you're opening up your company's books for the quarter, right? And you realize your core business is just absolutely tanking.
Oh, totally falling apart.
Yeah, falling apart. But then, you find this random, nearly $1 billion check in the mail, and suddenly, magically, you look like a total financial genius to all the Wall Street algorithms.
Right. It completely papers over the disaster.
Exactly. And that is exactly what just happened to Nike. So welcome to the deep dive. We are taking Nike's Q4 2026 earnings call, dumping the raw data on the table, and basically figuring out what's real and what's, well, a complete accounting mirage for you. Because, as a retail investor, you're just trying to make sense of this market.
And honestly, parsing that mirage is, it's more critical today than it has been in decades. I mean, you're looking at a brand that has completely dictated global culture, right? And footwear trends for what? An entire generation?
Oh, easily a generation, yeah.
But they are currently caught in this massive, just really painful strategic pivot. I mean, inside the walls over at Beaverton, they're throwing around these urgent terms like the Win Now initiative and the sport offense strategy.
Which sounds intense.
It is. They've restructured thousands of employees. So, it's a company operating with a really deep sense of urgency, mostly because their market share is just under siege from every possible angle right now.
Yeah, so the stakes really couldn't be higher. If you're managing your own portfolio, or, even if you just care about the economics of the retail sector in general, the fundamental question you need to answer today is whether the underlying data actually supports a comeback, or if that iconic swoosh is just, pointing straight down.
Pointing straight down to the floor, yeah.
So let's unpack this. Let's look at the raw data that hit the wire, because you just glanced at the push notification on your phone when earnings dropped. You were almost certainly misled.
Oh, 100%. Because the headline algorithm, it just strips away all the context. It takes all this incredibly complex corporate accounting, distills it into like 3 numbers, and spits it out to retail trading platforms.
Right.
And in the specific fourth quarter, context isn't just important. I mean, it is literally the entire story. If you're trading on the headline alone here, you are flying totally blind.
Well, let's fire off those headline numbers then, as presented by their outgoing CFO, Matt Friend. First, Q4 reported revenue came in down 1%.
Okay.
And if you strip out the currency fluctuations, what they call currency neutral, it was down 4%. So a slight top-line decline. But then you look at the profitability metrics. Earnings per share, EPS, came in at 72 cents.
Right.
And the gross margin was reported at a really robust 49.2%.
And we really need to pause on that 49.2% gross margin, because the CFO noted that it was up 890 basis points from the prior year.
Which is massive.
It's unbelievable. For listeners who aren't, staring at a Bloomberg terminal all day, there are 100 basis points in a single percentage point. So an 890 basis point jump means their gross margin supposedly expanded by almost 9 percentage points. 8.9 percentage points in a single year.
Wow.
Yeah. In the world of global retail and manufacturing, where these companies fight tooth and nail for like 0.1% of margin improvement, an 8.9 percentage point leap is just astronomical.
Right. So if you stop reading the release right there,
yeah,
you are thinking, wow, revenues are a tiny bit soft, but they've completely cracked the code on profitability.
Exactly.
You'd think they're making way more money on every single pair of shoes they sell. It looks like, the ultimate corporate efficiency story.
But the thing is, and this is the wild part, it's not an efficiency story at all. It is an absolute massive accounting illusion.
Right.
That 49.2% margin and that 72 cents of earnings per share, they are hiding an unplanned one-time windfall that fundamentally distorts how the underlying business is actually operating day to day.
An illusion to the tune of $986 million, to be exact. So let's break down the mechanics of this. How does almost $1 billion just randomly drop onto an income statement? Because this isn't money they made selling sneakers to people?
No, not at all. It comes down to international trade mechanics. During the fourth quarter, Nike recognized a one-time financial recovery of claims related to incremental tariffs paid under IEEPA.
Okay, so a tariff refund.
Exactly. And this generated a one-time benefit of $986 million. So over the course of fiscal year 2026, Nike had been importing goods, paying these heavily elevated tariffs, and baking those extra costs into their cost of sales.
Which hurts their margins.
Exactly. So for the past year, their profit margins looked artificially depressed because they were just eating these heavy tax hits.
And then suddenly they get this legal or regulatory determination that they shouldn't have had to pay those, or that they are owed a refund.
That's exactly the mechanism. In Q4, they received a determination that the recovery of these claims was, quote, probable. And under accounting rules, once that recovery is deemed probable, you get to recognize the benefit on your income statement immediately.
Just immediately on the books. Boom.
Boom. A $986 million credit hits the books all at once. By the end of May, they had actually collected over $300 million of it in hard cash. And the rest is just sitting in accounts receivable waiting to be paid out.
It's literally like finding a $100 bill on the sidewalk and acting like you got a raise at work.
That is a perfect analogy, yes.
I mean, it pads your wallet today, right? But it doesn't mean your salary actually went up. It tells you absolutely nothing about the actual health of your career, or in this case, the business. You just don't get a $1 billion tariff refund every quarter. That's a one-off event.
Which is exactly why the CFO had to walk the analysts on the earnings call through the actual underlying operating performance. When you extract that one-time tariff windfall from the equation, the narrative of the quarter flips entirely.
So what was the real number?
The true earnings per share wasn't 72 cents, it was 20 cents.
Whoa. From 72 cents plummeting all the way down to 20 cents. That is a completely different reality.
It's night and day. And that beautiful, robust 49.2% gross margin. Excluding the tariff benefit, the real gross margin would have been 40.2%.
So it actually went down.
Yes. That means their actual profitability on the goods they sold was down 10 basis points from the exact same quarter last year.
Yeah.
The underlying machinery of Nike's business, like the fundamental gap between how much it costs them to manufacture a shoe in Vietnam or China versus how much they can sell it for at a mall in Chicago, that did not improve by 8.9 percentage points. It contracted.
Okay, but to be fair to management, that 10 basis point contraction wasn't purely because materials got more expensive, right?
Yeah.
I mean, they did incur some hefty strategic costs this quarter.
That's true, yeah.
They took nearly $400 million in severance charges over the year to right-size their cost base. And that was heavily concentrated in North America and EMEA, Europe, the Middle East, and Africa.
Yeah, and that severance is a core component of this new Win Now initiative. They are basically taking the financial medicine right now, paying people out to leave the company so they can operate with a leaner, cheaper workforce moving forward.
Right.
But as a retail investor, you have to look at the ex-tariff numbers to value this stock today. You are buying a business generating 20 cents of EPS for the quarter at a 40.2% margin. That's the reality.
Okay, so if we pull off that $1 billion tariff Band-Aid and look at the actual wounds on the balance sheet, what is bleeding here? Because when you dig into the segment data, you realize this really isn't one cohesive company right now.
No, it's very fractured.
It's a profound tale of two Nikes. You have the lifestyle business on one side, and you have the performance business on the other.
And the transcript gets incredibly revealing when the CEO, Elliot Hill, addresses this exact divide. The glaring weakness, like the absolute anchor that is aggressively dragging down the entire top line, is Nike sportswear and Jordan streetwear.
Which is crazy to think about.
Yeah. The CFO confirmed that sportswear declined by double digits in the quarter.
Double digits. We really need to contextualize how massive that is for you listening. Sportswear and Jordan represent roughly half of Nike's total global revenue.
Exactly, 50% of the pie.
So if 50% of your business is declining by 10, 12, or 15%, that is a multi-billion-dollar crater forming in the middle of your operations. Why is the demand for casual lifestyle shoes falling off a cliff like this?
Well, the key metric they pointed to is that sell-through remains highly challenged. And for the listener, it's super vital to understand the difference between sell-in and sell-through.
Right. Wall Street uses those a lot. Break it down.
Okay, so when Nike manufactures a batch of, say, retro Air Jordans and ships them to a retail partner like Foot Locker or Dick's Sporting Goods, Nike records that as a sale on their books. That is sell-in. But the transaction doesn't end there.
Right, because Foot Locker still has to actually convince a human being to walk into the store and buy that shoe off the shelf.
Exactly. That final transaction with the actual consumer is the sell-through. So when management says sell-through is challenged, it means those shoes are literally sitting in Foot Locker's stockroom collecting dust.
And when inventory sits, a pretty brutal chain reaction begins.
Oh, it's terrible. First, the retailer has to start discounting the shoes just to clear up physical space, which totally damages the premium perception of the brand.
No one wants a luxury sneaker on a discount rack.
Exactly. And second, and this is way more important for Nike's bottom line, when it comes time for Foot Locker to place their wholesale orders for the next season, they order significantly less product, because they are still choking on last season's inventory.
It's the classic bullwhip effect in retail supply chains.
Yeah.
But it still begs the question, why are consumers suddenly leaving Dunks and Jordans on the shelf? I mean, for the last 5 years, sneakerhead culture drove the entire industry. You couldn't walk down a street without seeing someone in a fresh pair of lifestyle Nikes.
You really couldn't. But the primary culprit management pointed to is a severe macroeconomic squeeze on the global consumer. Matt Friend noted a very specific timeline here. They saw a strong start to the quarter in March, but then retail sales trends decelerated sharply beginning in late April.
Just dropped off.
Yeah. Traffic dropped, and discretionary spending dried up almost simultaneously across multiple global geographies.
It's like the consumer just collectively hit a wall in the spring.
They really did. And management noted a high correlation with fluctuating unavoidable living expenses. So in North America, for instance, they track this alongside gas prices and grocery inflation.
Oh, that makes total sense.
Yeah, when everyday consumers are suddenly paying like 20% more to fill up their cars and feed their families, the appetite to drop $150 on a fourth pair of casual lifestyle sneakers just evaporates.
Sneakerhead culture thrived in a low interest rate, high stimulus environment.
Exactly. In a high inflation environment, retro basketball shoes become a highly deferrable purchase. You don't need them to survive.
And we see that consumer exhaustion playing out pretty viciously across the globe. Let's look at the geographic breakdown, starting with EMEA, so Europe, Middle East, and Africa. Total revenue there was down 6%. But the pain was incredibly concentrated in their direct-to-consumer channels.
Yeah, the numbers there are rough.
Nike Direct declined 16%, and their digital sales plummeted a staggering 24%.
And that digital collapse in EMEA is a direct result of Nike being forced to make a very painful strategic choice. See, EMEA traditionally has a higher portfolio mix of sportswear compared to other regions.
So they sell a lot more lifestyle shoes over there.
Right. So because they are heavily over-indexed in the exact lifestyle category that is struggling globally, they took a totally disproportionate hit. The region was flooded with heightened inventory, and competitors were running these heavy promotional fire sales to clear out their own excess product.
Everyone was slashing prices.
Yeah.
But Nike decided not to play the discount game this time, right?
That is the strategic choice. To protect the premium halo of the brand, Nike took aggressive actions to reduce off-price sales in EMEA by over 50%. They deliberately stopped blasting consumers with 30 or 40% off coupon codes.
Wow.
The goal was to force a 15-point improvement in full price realization.
So they chose margin integrity over raw sales volume. They essentially said, look, we would rather sell fewer shoes at full price than move 1 million pairs at a huge discount and train the consumer to wait for a sale.
Exactly. It protects the brand long-term, absolutely.
Yeah.
But it totally nukes your digital revenue in the short term, hence that 24% drop.
It is a bitter pill to swallow, but I guess it resets the baseline. And the complexity only increases when you look at Greater China. Because China was honestly the most shocking segment of the entire transcript for me.
Oh, it was a rough read.
Q4 revenue in Greater China declined 17%. Nike Direct was down 14%. Wholesale down 19%. And EBIT earnings before interest and taxes, which is essentially their core operating profit for the region, that was down 20%.
Yeah, China is an incredibly nuanced battleground right now. The CEO stressed that it remains a critical long-term growth engine, of course. But right now, they are executing a pretty comprehensive reset. They're actively working with local retail partners to clean up aged inventory over there.
But there's more to it than just inventory, right?
Oh, definitely. Underneath those numbers is a fierce, kind of unspoken battle for market share against highly aggressive, really nimble domestic brands in China.
Like Anta and Lining.
Exactly. Anta and Lining have vastly improved their product quality and localized marketing over the last 3 years. They are eating into Nike's dominance.
So you have a global macro squeeze, you have massive double-digit declines in lifestyle, digital revenue collapsing in Europe, and a 17% drop in China. I mean, it paints a very bleak picture.
It really does.
But then you look at the other side of the ledger. You look at the performance business, and it is a completely different universe.
This is the critical insight behind Elliot Hill's obsessive focus on this sport offense thing. Because when Nike remembers its heritage, like when it operates as a sports technology company first and a fashion company second, it actually wins.
Yeah, the data backs that up.
It does. The performance sports categories grew mid-single digits globally this fiscal year.
Well, let's talk about running, because they dropped a stat that legitimately made me do a double take.
Yeah.
Over the last 5 quarters, Nike Running added roughly $1 billion of incremental revenue to their business.
$1 billion in just over a year. That is a phenomenal, aggressive turnaround for a category where Nike had arguably lost significant ground.
Oh, they definitely had.
Yeah, I mean, go to any local marathon over the last few years, and what do you see? A sea of Hoka, On Running, Brooks. Nike had totally allowed themselves to get complacent in everyday running, but the data shows they are finally clawing that market share back.
Right.
In fiscal year 26, across Western Europe and North America, Nike gained 5 full points of running market share in statement footwear.
And the CEO made sure to point out that a 5-point market share gain was more than any other top 5 brand in the entire space.
Right.
They specifically highlighted the Peg 42, the latest iteration of the Pegasus line, which features that full-length encapsulated Zoom airbag.
Right.
They said it is selling through incredibly well at full price. Mm-hmm. And they are already teasing the innovation pipeline, talking up the upcoming Vomero Plus 2 and the integration of advanced materials like AeroFit into their running apparel.
They're returning to their core competency, actually solving functional problems for athletes. And it's not just running either. Global football, which is soccer for our North American audience, that's experiencing massive momentum right now. They are masterfully leveraging the global energy of the World Cup.
Yeah, Elliot Hill talked about their approach to the World Cup, not just as a one-off sporting event, but as an opportunity to build an entire, quote, Nike football universe, which is great marketing. They launched this massive brand campaign called Rip the Strip, unveiled deep, compelling athlete storytelling, and backed it up with highly innovative product drops.
And the metrics on the football side are just staggering. They sold 2.5 times the number of AeroFit national team kits compared to the same period during the 2022 World Cup.
Wow, 2.5 times.
Yeah. And the new Mercurial cleat. It became the fastest-selling 24-hour launch for cleated footwear in the entire history of Nike Direct. By the first week of the tournament, they had already generated 1.5 billion views across their various digital storytelling campaigns.
Which proves that when Nike focuses on authentic sport, their legendary marketing machine still functions flawlessly. And the consumer still opens their wallet. We see similar bright spots in basketball, too.
Absolutely.
They just executed a really brilliant talent maneuver, signing Shai Gilgeous-Alexander to the flagship Nike basketball family, moving him over from Converse. This allows Converse to focus purely on lifestyle, while Nike bolsters its performance basketball roster.
Right, keeping the lanes clear.
Yeah. They are heavily hyping the Sabrina Ionescu shoe, and noted that Caitlin Clark's highly anticipated signature shoe is slated for holiday 2026.
They are locking down the next generation of authentic cultural icons in performance sports. And this renewed focus is actually beginning to heal some of their most fractured wholesale relationships.
Well, it's like with Foot Locker.
Exactly. In North America, the CFO noted that revenue growth and retail sales comps with Foot Locker were positive for the first time in 4 years.
Wait, okay. I'm looking at this billion-dollar growth in running, the record-breaking World Cup soccer sales, positive momentum with Foot Locker. How does the total revenue for the company still go negative? I mean, the math just isn't mathing for me here. If performance is on fire, why is the overall engine stalling?
It all comes down to sheer brutal proportions. As the CEO plainly stated, sportswear and Jordan streetwear together represent approximately 50% of Nike's total revenue pie.
So if half your entire business is sick, a few bright spots in the other half simply cannot cure the patient.
Exactly. Even billion-dollar bright spots. Let's look at the sheer magnitude of the surgical intervention management is attempting right now. Because the CFO revealed they're intentionally, deliberately reducing the supply of classic footwear franchises by more than $2 billion.
I really want to make sure the listener understands the gravity of that statement. They are taking $2 billion worth of highly popular product, think classic Air Force Ones, retro Jordans, standard Dunks, and intentionally pulling them off the market. Why would a company struggling for revenue voluntarily kneecap their own sales?
It's basically the Disney Vault strategy applied to footwear.
Explain that.
Well, if you leave a classic movie like Cinderella on the shelf forever, it loses its magic, right? People ignore it or wait for it to hit the discount bin. But if you lock it in a vault and artificially restrict supply, suddenly people are willing to pay a premium the absolute second you re-release it.
Scarcity.
Exactly. Nike saw that the market was just totally oversaturated with Dunks and Air Force Ones. So to avoid a catastrophic scenario where their most iconic cultural silhouettes end up sitting on clearance racks at generic outlet malls, which completely and permanently devalues the brand, they are pulling $2 billion of inventory into the vault.
So they are starving the market to manufacture desire. It is a brilliant long-term brand preservation tactic, I have to admit. But in the short term, you create a massive immediate revenue crater.
That is the mathematical reality they're facing. Even hypergrowth in performance categories like running or basketball cannot mathematically plug a sudden $2 billion hole overnight. The performance engine is revving, sure, it's generating real heat, but it is trying to tow an absolute massive anchor of intentionally suppressed lifestyle sales.
And it takes time for a tanker of this size to completely shift its weight from fashion back to performance. Which brings us to the forward-looking guidance. This is arguably the single most critical section of the earnings call for an investor trying to price this stock today.
Oh, without a doubt.
Because if the core lifestyle business is struggling against macro headwinds and management is intentionally holding back $2 billion in classic franchises, that fundamentally alters what they expect for the coming year.
And frankly, the guidance was a significant downgrade. It represents a stark shift in expectations from what they were telling Wall Street just 3 months ago.
Let's translate what the CFO laid out for fiscal 2027. Previously, management had guided that for the first half of the year, so Q1 and Q2, they expected revenues to be down low single digits and for earnings to be relatively flattish.
Right.
Now, flattish earnings during a massive corporate restructuring sounds acceptable. You're holding the line while you rebuild.
Yes. But on this call, the top-line expectation deteriorated. They now expect Q1 and Q2 revenues to be down, quote, low to mid-single digits.
Adding the word mid is doing a lot of heavy lifting there. It's a subtle, calculated acknowledgement that top-line demand is getting tangibly weaker than they modeled.
And they went a step further, too, issuing a very specific direct warning regarding the second quarter. The CFO highlighted that Q2 will see a sequential deceleration from Q1.
Sequential deceleration, meaning Q2 is going to be materially worse than Q1. What is driving that specific dip?
Well, he pointed to a multi-point headwind created by some very unique, really unforgiving year-over-year comparisons. First, we have to look back at EMEA.
Okay.
Last year during Q2, Nike ran extremely heavy, aggressive digital promotions to clear out a massive inventory glut in Europe. As we discussed earlier, this year they have drastically cut back on off-price sales to protect the brand's premium image.
Right. So when Wall Street algorithms compare this coming Q2, where Nike is stubbornly holding the line on full-price sales, to last year's Q2, where they were running a massive digital fire sale, the raw revenue drop is going to look catastrophic.
Exactly.
You simply move less volume when you aren't blasting 40% off codes to everyone on your email list.
Exactly. It's an optical deceleration driven by a strategic choice. Now, the second headwind is a timing anomaly with North American wholesale shipments.
What happened there?
Last year, a chunk of wholesale orders that normally would have shipped in a different quarter got pushed into Q2. This artificially inflated the revenue for that specific 3-month window. So when you compare this coming Q2 against that artificially pumped up quarter from last year, the growth numbers are going to look exceptionally weak.
So for the retail investor listening, management is explicitly telling you to brace for impact. Be prepared for some very ugly top-line revenue numbers when Q2 rolls around. The transition pain is just far from over.
Very far.
But here is the paradox. You mentioned they still expect overall earnings to remain roughly flattish, despite revenue dropping further into the mid-single digits. How on earth do you keep earnings flat when your sales are falling faster than you originally thought?
This is where we see the cost-cutting cushion actively deploying to save the bottom line. The major silver lining in this revised guidance is that management now expects gross margin expansion to begin earlier in the year. Previously, they thought margins wouldn't inflect positively until Q2. Now, through just brute force operational discipline, they expect gross margins to be slightly positive beginning in Q1.
How are they engineering better profit margins on falling sales volume? It seems counterintuitive.
Through aggressive structural supply chain efficiency and taking a ruthless line on inventory management, they are heavily tightening their buys from overseas factories, vastly reducing the future sell-in of product to the marketplace, and operating with a much, much leaner corporate overhead.
Oh, so that goes back to the $400 million in severance charges we talked about earlier. They took the massive financial hit last year to buy out employee contracts, reduce headcount, and consolidate the number of physical facilities they operate.
Precisely. The painful cost was paid in fiscal 26. Now, in fiscal 27, they get to operate the business without having to pay those salaries, those benefits, or those facility leases.
Right.
That structural cost reduction immediately drops to the bottom line, boosting their margins. Furthermore, they are reallocating technical resources away from broad, kind of generic corporate tech initiatives and embedding those teams directly into the value chain to improve manufacturing speed and logistics.
And there is a secondary margin benefit to that Disney Vault strategy we mentioned. By intentionally starving the market of $2 billion of classic footwear, they are forcing a more full-price business. Less supply in the channel naturally means less discounting at the retail level.
Yeah.
And less discounting means a significantly higher profit margin on every single shoe that does eventually sell.
It is the ultimate corporate balancing act. They are intentionally shrinking the total size of the business in the short term to ensure that the remaining business operates at a much higher, more premium rate of profitability.
And that potent mix of near-term revenue pain, coupled with aggressive internal restructuring and margin engineering, paints a very specific, highly volatile picture for retail investors trying to value Nike stock today.
It really does.
Which brings us to the bottom line. We stripped away the billion-dollar tariff illusion, we've unpacked the deep divide between the collapsing lifestyle business and the resurging performance business, and we've analyzed the downgraded guidance cushioned by structural cost cuts. Now it's time to take a position. What is the actual verdict on this quarter?
Well, if we synthesize all the underlying data, my position is that these results are fundamentally weak. They reflect a company caught deep in the trenches of a very painful, highly protracted transition period.
Yeah, I have to agree.
Once you back out the $986 million accounting windfall, the core operating business is struggling heavily against an exhausted consumer base and really fierce macroeconomic headwinds. The turnaround is undeniably taking much longer than management initially hoped.
The reality is that the casual consumer, the ones who drove the massive streetwear boom over the last 5 years, they are stepping back. Nike's core lifestyle product, the high-motion fashion sneakers that pay the bills, is in a double-digit freefall.
Exactly.
So for you listening, if you're currently holding this stock or perhaps looking at the lower share price and thinking about buying the dip, you have to look closely at the actionable timeline management laid out.
The timeline is honestly the most critical piece of actionable intelligence from this whole call. Elliot Hill explicitly discussed the formation of the new cross-functional sport offense teams. These are the internal groups tasked with obsessing over consumer insights, speeding up the manufacturing pipeline, and driving a relentless flow of new, highly innovative product to the market.
Right, the team meant to save the day.
Right, but he also offered a really sobering reality check on their speed.
He stated point blank that these teams are just now getting to work. And he noted that the first time the market will actually see the tangible fruits of these teams' efforts, bringing a new shoe from initial design brief all the way to a physical retail shelf, will be spring 2027.
Spring 2027. That is your actionable timeline as an investor. Until that product hits the market, Nike is relying almost entirely on cost-cutting, structural supply chain improvements, and clearing out old-aged inventory just to tread water.
It's a waiting game.
Investors are essentially being asked to wait. They are being asked to endure a minimum of 3 to 4 more quarters of turbulence before the cavalry arrives.
And Elliot Hill knows exactly what he's asking of Wall Street. I thought the way he ended his prepared remarks was incredibly revealing, because he didn't end with financial metrics or basis points or margin projections. He ended with a sports metaphor.
Oh, yeah.
He talked about the New York Knicks winning the NBA championship earlier this month.
It was a very deliberate, kind of calculated choice of imagery for a CEO leading a struggling turnaround. He talked about how a championship culture isn't built in a single playoff series. It is forged over time through painful setbacks by buying into a unified system where everyone intimately knows their role.
Exactly.
He compared Nike's current operational struggles to a grueling finals series, facing double-digit deficits, refusing to panic, and methodically chipping away at the lead, possession by possession.
One stop, one bucket. another stop. That is exactly how he described it on the call. He said that is the resilient mindset he sees in his team at Nike right now. They openly acknowledge they aren't where they want to be today, but they believe they are meticulously building the foundation the right way, block by block.
It is an inspiring, really authentic plea for trust from a CEO who is desperately trying to rally both his internal employees and his external shareholders. But, as beautiful as the metaphor is, it brings up a highly critical, really pragmatic reality about the global retail market.
Which is what?
Well, Elliot Hill is asking retail investors to blindly trust the rebuild, just like long-suffering Knicks fans did. But sports fandom is a captive audience, right? You don't just switch teams because yours is having a bad season.
That's a great point.
In the incredibly fast-moving, highly fragmented world of global apparel and footwear, loyalty is totally fleeting. Nimble competitors like On, Hoka, Anta, and New Balance, they are constantly innovating, iterating, and aggressively stealing market share every single day.
It's true. The consumer owes Nike absolutely nothing.
Exactly. So the final thought you have to mull over as an investor is this. Will today's financially squeezed, highly discretionary consumer patiently wait around in their old shoes for Nike's championship season to finally arrive in spring 2027? Or will they just take their money and buy their sneakers somewhere else today?
That is the multi-billion-dollar question that will ultimately determine the future of the swoosh. So keep a close eye on those fundamental sell-through numbers, brace yourselves for a highly turbulent Q2, and we'll see you on the next deep dive.